Hello, bonjour, Tansi. I'm Claire from the Family Law Information Center. Welcome to our presentation on finances during separation. This presentation includes information on creating a balance sheet of your assets and liabilities, how to make a household budget, strategies for managing debt, and separating your financial accounts. In a spousal relationship, it is common for one spouse to handle the bulk of the family's finances. During separation, it is important that both spouses have a good understanding of where the family stands financially. This will help ensure issues such as property division, spousal support, and child support can be dealt with fairly. It also puts both spouses in a position to plan for their future as they establish two separate households. In order to have a good understanding of your financial situation, you should know what you own and how much you owe, know your monthly income and your monthly expenses, and make a household budget. A good first step is to get organized. Gather all your financial documents. These will include account information for all bank accounts, investments, and loans, insurance information, recent pay stubs, and your tax returns for the previous 3 years. You may also wish to consult a financial planner or tax accountant to provide you advice on the financial and tax implications of dividing your property and separating your accounts. Once you've gathered your documents, make a list of your assets and liabilities. Your assets are the things you own, such as your home, vehicles, bank accounts, investments, and personal property. Liabilities are your debts, the amount you owe, such as the balance owing on your mortgage, car loans, student debt, and credit card debt. When listing the value of your assets, be sure to list the current market value, what the item could be sold for, not what you paid for it. You may need to get some items, such as your home or vehicles, appraised to know their current market value. After listing your assets and liabilities, you will have a balance sheet that looks something like this. The value of your assets minus your debts is your net worth. This is the simplified example. You may want to add more detail to your own balance sheet by listing each asset separately. The lines for bank accounts and loans should include the name of the institution and account number. Making a detailed balance sheet is an important first step in the process of dividing your property. You'll also want to make a budget. A budget is a plan for how you manage your income and expenses. It is a good idea for everyone to have a budget, but budgeting is especially important during the separation process because the same income will now need to support two households instead of one. Budgets can be made for any period of time, but most budgets are monthly or yearly. Making a budget will help you know where your money is going, make sure you can meet your financial obligations, and save money to meet your financial goals. When making a budget, write down your income from all sources. If you are making a yearly budget, write your yearly income. If you're making a monthly budget, write your monthly income. Consider sources of income such as employment income, self-employment income, tips and commissions, employment insurance benefits, and child and spousal support if you receive those. Next, write down your expenses. It may be helpful to look back at your spending over the past few months to get a sense of your monthly bills and how much you are spending on various expenses. If you are making a monthly budget, make sure you are factoring larger expenses that may not arise each month. Larger expenses may be things like home insurance, vehicle registration, or tuition fees. Calculate the total of these expenses and divide by 12 to make sure you are setting aside enough money for them each month. If you use your gross income, the amount you make before deductions for things like the pension plan, employment insurance, and income tax, make sure you list those deductions in your expenses. Once you have your total income and total expenses, subtract your expenses from your income. This is the amount you have left over each month. Your final budget will look something like this. If you have surplus income at the end of the month, that money can be used to pay down debts faster or save for emergencies or larger purchases. If your expenses each month are higher than your income, you will need to look for ways to increase your income or reduce your expenses. If you need to reduce your expenses, try to eliminate unnecessary spending on things like eating in restaurants, travel, and buying clothing and toys you don't need. Cut back on cable, internet, and cell phone plans. Make sure your housing fits your budget. Avoid using credit cards unless you can pay the full balance each month. Credit card interest can be a significant monthly expense if you are not paying off the balance regularly. When you are trying to reduce spending, it can be helpful to divide your expenses into needs and wants. Needs are necessary expenses such as food, shelter, and clothing. Wants are discretionary expenses such as entertainment, travel, and luxury items. Every family's wants and needs will look a little different. Often, things do not fit perfectly into one category or another. For instance, you might consider your cell phone a need, but a cell phone plan with unlimited calling, texting, and data might be a want. When reviewing and adjusting your budget, make sure you have enough money to spend on the things you need first. Whatever money is left over can be put towards things you want, paying down debt, and saving for emergencies. The Government of Canada has several online financial resources, including an online budgeting tool. You can find these tools by visiting canada.ca and typing Financial Tools and Calculators into the search bar at the top of the page. During separation, it may be tempting to use credit cards or other loans to make up for the reduction in your income, but you should avoid this if at all possible. When your spending exceeds your income, your debt load increases. In turn, more of your monthly income must go to paying interest and paying down your debt. This leaves less money available to cover other expenses, increasing the likelihood you will need to borrow even more. This is sometimes referred to as the debt cycle. If you are having problems with debt, it's best to start dealing with them as soon as possible. A good first step is to stop borrowing money to meet regular expenses and make a plan to pay down your debt. Use your budget to eliminate unnecessary spending and budget a certain amount per month to put towards paying down credit cards and loans. Concentrate on paying down the debts with the highest interest rates first, but try to make sure you are making the minimum monthly payments on the other loans. Failure to make minimum payments can negatively affect your credit score. If you are still having difficulty meeting your debt obligations, you can consider taking more drastic action. Options include consolidating your debt into one loan, negotiating a payment plan or lump sum settlement with creditors, making a consumer proposal, and filing for bankruptcy. Each of these options has pros and cons and can impact your credit rating. It is important to do your research and think carefully about each option before deciding which course of action is right for you. You may want to talk to an accredited credit counselor about these options. For more information on your options for managing debt, you can visit the Debts and Credit section of plea.org or visit canada.ca and search for Managing Debt. Once you have prepared a balance sheet of your assets and liabilities and have begun working on a budget, you should have the information you need to begin making decisions about property division and spousal support. You can find more information about these topics in other videos in this series. One big decision that separating homeowners face is whether they can afford to keep the family home. It is important that this decision not only be based on whether you can afford to keep up with mortgage payments. You also need to make sure you are prepared to pay for things like taxes, routine maintenance, and emergency repairs on the home. If you do decide that one spouse will keep the family home, it is a good idea for that spouse to ensure they will qualify for a mortgage on their own before the division of property is finalized. You'll also need to begin separating your accounts and making sure all of your information is up to date. This will include getting a bank account and credit card in your own name, making decisions about whether you want to close joint accounts and cancel joint credit cards right away. Some people find it easier to leave some accounts open for a period of time. You need to be aware that if you leave joint accounts open, both spouses will continue to be able to access the funds in those accounts and will be equally responsible for any debts. Make sure your health insurance, life insurance, and disability insurance plans are up to date and have the correct information. Finally, you should update your will and other estate planning documents such as powers of attorney and healthcare directives. If you do not have a will, you may want to think about making one. For more detailed information on dividing your accounts, visit canada.ca and search Dividing Your Finances. If you are looking for more information about family law, it may be useful to watch other videos in this series. These videos have information on ending spousal relationships, parenting arrangements, child support, spousal support, and dividing family property.